Hello friends, welcome to the month-end series of ABM. In month-end series, as you know, we are covering all the compulsory subjects of CIB. ABM, BFM, ABFM, BRBL, all of them. So watch the complete series. Share this video, share this channel with your friends, like the channel, subscribe to the channel. Okay? All the previous year questions are covered. Case studies, numericals. Today also, you see. Today also I'll be covering. This topic is Treasury and ALM, Asset Liability Management. So in this also I'll be covering some objective questions as well as some numericals. Very important ones. So that's why watch this video till the end, share it with your friends, like this video. Okay, subscribe to the channel. Let's start. Consider a bank, numerical. Consider a bank with the following interest rate sensitive assets and liabilities maturing within 3 months. So the bank is having these interest rate sensitive assets and liabilities, okay, maturing within 3 months. Now what are interest rate sensitive assets? See, which are affected by the interest rate. Asset means what? Loans. So loans are affected by the interest rates, isn't it? Suppose if I am giving the fixed rate component, so fixed rate component, then it will not be affected. But floating rates will be affected by the interest rate components. Which are the assets which are not interest rate sensitive? Cash. Cash does not have any interest rate sensitivity. Similarly, liabilities. What are the liabilities? Saving, FD, these are all interest rate sensitive. Interest rate changes, your saving FD rate changes. Current account? No, zero. Because current account you don't give any interest only, isn't it? Nowadays on savings also, what do you give? 2.5% roughly, isn't it? So very less now. Now the days of interest rates are gone. So move on. Our topic is different. Consider the bank with the following interest rate sensitive assets and liabilities maturing within 3 months. So what are these rate sensitive assets? Short-term loans maturing in 1 to 3 months, 2000 crores. Investments repricing 1 to 3 months, 1000 crore. So look at this. These are loans. Okay. Short-term loans, these are all assets. Asset means loans which I have given. Kindly understand. These are the loans which I have given, not which I have taken. Okay. See, this is called as borrowings. Kindly note, loans can be of two types. Loans which I give and loans which I take. Which I give, we'll call them loans. And which I take, we call it borrowings. This is taken. So again, these are loans only. So now, assets. 1 to 3 months is 2000 crores. These are my assets. So here I'll earn the interest. Similarly, investment repricing in 1 to 3 months, 1000 crores. Now, what are my total rate sensitive assets then? Assets. I want only assets now. So it is 3000 CR. Right? 2000 plus 1000. 3000 CR. This is my rate sensitive asset. Rate sensitive liabilities. Short-term deposits maturing in 1 to 3 months. So these are all liabilities. It is 2500. Borrowing repricing for 1 to 3 months is 800 CR. So 2500 and 800. So these are my liabilities. Here I have to give the interest. Okay. So it is what? 25 plus 8, 33 CR. Okay. Now what do you see from this? And what is the question? Is the bank in profit or loss if the interest rate rise? If the interest rate rise, so is the bank in profit or loss? If the interest rate rises, what do you think? If the interest rate rises, will the bank be in profit or loss? Think over it. Okay, let me show you. Okay. Let's solve this. Let's take one hypothetical case. Okay. Means my assets are 3000, loans I will say. Let's call it simple terms, loans. 3000 CR. Deposits or liabilities. Liabilities are 3300 CR. Just now we saw this. Right? Now let's say my rate of interest is, let's take common for both. Let's say my rate of interest is 5%. Simple. It is 5%. So ROI equals to let's take this common. ROI equals to 5%. Okay. Now what happens? How much do I receive? I'll be receiving 3000 crores into 5% yearly. 3 5 the 15, right? So it will be what? 300, 150. So plus is 150 CR in a year. In a year, this is yearly, year. Plus is 150 CR and gone. How much is going out? Minus is 3300 into 5%. So it is what? 3 5 the 15, 165 minus 165 CR going out. Okay, 165 CR going out. Getting this point? Are you getting this? Whatever I am doing. This is rate of interest is 5%. Loans, I'll receive the interest. 3000 into 5%. 150 CR. Deposits or liabilities, I'll give the money. So it is 3300 into 5%. Again 165. This figure we have, these two figures we have got it from year. Okay, 3000 and 3300. Okay. Now let's say the ROI. See, so here my negative gap is what? Negative gap is negative gap minus 15 CR, right? So my negative gap is minus 15 CR. Now what happens? ROI becomes, let's take it round, 10%. 10%. What will I have now? ROI is 10% now. So it will be 3000 into 10%. So it is 300 plus is 300 CR. What is minus? Minus is 3300 into 10%. Okay, so 330. 330 CR. So now what is the negative gap? Negative gap equals to minus 30 CR. So now you tell me, what is the question? Is the bank in profit or loss if the interest rate rises? The interest rate has risen. So will the bank be in profit or loss? It will be in loss. Right now, loss means more loss. Right now only it's in loss. But it will be in more loss. So here the loss is minus 15. There the loss is minus 30. So the bank will be in loss. More loss you can say. Okay. Got this point everyone? This is called as liability sensitive bank. See, there are two terms over here. One is liability sensitive bank. Second is asset sensitive bank. Okay. Whenever you have a liability sensitive bank, I'll give you a thumb rule over here. Okay. Let's write it this way. Liability sensitive bank. Okay. And then interest, asset sensitive bank means there it is having more assets. Means this asset side will be more. Asset sensitive, I'll just write sensitive and bank. Okay. Now if interest rate rises, interest rate goes up, interest goes up, then liability sensitive bank will be in a loss and asset sensitive bank will be in a profit. And reverse is for interest goes down. If it goes down, then liability sensitive bank will be in a profit and this bank will be in a loss. Got it? Simple rule you must remember. This thumb rule you must always remember. This is a part of your module C. Yeah, in C you have this. Okay, so don't miss this term. Got it everyone? Move on, next one. Let's solve some theory now. Theory part. A positive interest rate gap. See, just now we did this and now the question. RSA greater than RSL indicates that if the interest rate rises, the bank's net interest income is likely to. So if the interest rate goes up, so your assets are more. So asset sensitive bank, your assets are more. So your income will what? Increase or decrease? Forget all these two. These two remain, forget this. Okay, increase or decrease. Just now I gave you. So it will, look at this table. So this. Asset sensitive bank, assets are more, right? Interest rate rises. So my increase, I'll profit. So my income will increase, right? increase. Got this, everyone? It will increase. Remember this thumb rule, this table by heart. This table, very important table. Okay? Liability sensitive bank, interest rate up, bank is in a loss. Remaining you can solve it then. Asset sensitive bank, interest up, profit. Liability sensitive, interest down, loss. Sorry, profit. And asset sensitive, interest down, loss. Okay? The risk arising from unanticipated deposit withdrawals or non-renewal of deposits is known as, okay, unanticipated withdrawals, unanticipated, urgent, without knowing, something bad comes out in the name of your bank. Something comes in the newspaper, this bank has gone bankrupt, something like this, anything comes. Huge fraud of 50,000 crore in the bank. All the customers come running to the branch. Cash, 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 cash. Isn't it? So what is that known as? Market risk, credit risk, funding risk and operational risk. Unanticipated withdrawals. Yes, it's a part of funding, isn't it? It will be a part of your funding risk. Actually, this withdrawals happening means it can be called as an embedded risk also. Okay, but here we have to choose between the options given. Okay, there can be other names also, but here we have to choose with the options given. So options given are these four: market, credit, ops and funding. So funding, isn't it? Funding risk means what? You don't get appropriate money whenever you require it. That is funding risk. Liquidity risk is primarily managed by ALM, in ALM by. So how will you manage the liquidity risk in the bank? Liquidity risk means what? That risk such that I'm facing the cash crunch. See, every bank faces liquidity risk. It's not that it's some serious issue. Every bank has a liquidity risk. Okay? Because every bank has more expenses than the income. That's a general rule. In your life also you have the same thing. You'll always have more expenses than your salary. Simple, isn't it? So, liquidity risk, diversifying the loan portfolio, managing the maturity profile of assets and liabilities. Now, in ALM we are talking specifically in ALM. Investing in long-term assets and reducing the number of branches. Liquidity risk in ALM, how is it managed? Means basically you are talking of treasury. Now this loan portfolio, is this a job of treasury? No, this is a job of business, right? So this is out. That's why, see, this is right answer. Diversifying loan portfolio will definitely reduce the liquidity risk. Okay, but this is not the right answer for this. The right answer over here is this. Managing the maturity profile of assets and liabilities. That is the main point we have to focus on. Assets and liabilities. Okay, very important point. Investing only in long-term assets. Now that is again not the part of this ALM. Of course, it can be a part of ALM because treasury is also allowed to invest. But investing in long-term assets will not cause that much effect on the liquidity part. Liquidity is a short-term issue. Kindly note one important part, liquidity risk. Risk is a short-term issue. It's a short-term, okay, short-term. So this long-term assets investment will not affect this liquidity that much. So this is out. Reducing the number of branches, that's not the answer, isn't it? Reducing the number of branches, that's a business call. You can't do anything in ALM over here, okay? Numerical. Consider a bond, price of 120 with a Macaulay duration of 7 years and YTM of 6%. If the interest rate falls by 2%, what is the new price of the bond? Think. This you have already done in your JAIIB also. This you have already done in your JAIIB also. This duration is called as, there is a duration called as modified duration. You have to find out the modified duration. Two durations are there. One is Macaulay, Mac, and second is modified. Do you know the meaning of these? Macaulay means that duration within the life of that bond, within the life of the bond, in which the interest rate risk is zeroized. Interest rate risk equals to zero. So that is Macaulay duration. This Macaulay which is given means that interest rate risk is zeroized. Modified duration means for 1% change in benchmark. Okay, what is the percentage change in the price of the bond? Percentage change in price. So this is basically what is required. We require this part. This part is required. This already we have. So if the interest rate falls by 2%, what is the new price of the bond? Find Macaulay modified duration. So mod equals to, what is the formula for modified? Mod equals to Macaulay Mac upon 1 plus R. Mac upon 1 plus R. So what is Mac given? Mac is given as 7 years. Okay. So 7 years upon, what is it? 7 years upon R is given as what? 6%. So 1.06. Solve this. 7 upon 1.06. Solve this, everyone. 7 upon 1.06. What are you getting? 7 upon 1.06. 6.6 something? 6.603. Take it 2 points only. That's okay. 6.60. Okay? 6.60%. Now what is the question? If the interest rate falls by 2%. Now look at this. There is a theorem on bonds which says that the interest rate and the price of the bonds are inversely related. So interest rate up, the price of the bond, price will be down, and vice versa. If interest rate down, price is up. So interest rate down, price will be up. So which is the case? Interest rate falls down. So this is the case we have to follow. Interest rate is down, the price will go up. By how much? This percent, 6.6. Based on what? My original price. What is the original price? 120. So my price will rise now. By what percent? 6.60%. So what is the actual rise? Find this. So actual rise equals to actual rise. Okay, so that is equal to what? 120 into 6.6%. So that is equal to 120 into 6.6%. Now solve this. 120 into 6.6%. Solve it, everyone. It is 7.92. Okay, the rise is 7.92. So it is 7.92, and that is what? Rupees. That is in rupees. So my price will rise. What is the new price of the bond? So my new price of the bond will be what? It is rise. So new price of the bond equals to new price equals to 120 plus what is this? 7.92. That is equal to 127.92. That is rupees. Okay, that is rupees. So that is the answer. Okay. Kindly note, it is 127.92. Kindly note, what you have to always focus on is modified duration. This is the most important term in your bond calculations and in treasury. Modified duration will give you the change in the price of the bonds with respect to the repo rate or any benchmark, whatever you are comparing. Got it? Clear? So now, before going, everyone kindly join the Adda 24/7 batches. Kindly join them ASAP. First, download the app from Play Store as well as iPhone, both. Okay? Both of them you download it and then join this. because there you will get 1% extra discount. See this. Go to Adda 24/7. Click on this. See these batches. Officer Pro batch. Ebooks, mock test, live classes, recorded sessions, AI assistant, everything you are getting. Ebooks and mock test are to the level of chapter wise. Mock test you are getting chapter wise also, full length also, same as exams. And discount, use discount right now. See this, use the code, never forget this code, Y432. Okay? See this, never forget this code. It is 80% discount, Y432, and plus 1% through the app, 81% discount. It's a huge thing, 81% discount. Got it? 81% discount you are getting. Plus, if you join the Mahapack, see this, Increment Mahapack. This is one of the best Mahapacks for you. JAIIB Increment Mahapack. Right now you are getting double validity. You buy for 6 months, you get it for 12 months. You buy for 12 months, you get it for 24 months. Plus ebooks, mock tests, 15 plus batches per subject, 15 plus, huge. Imagine that much revision you do. Enough. Okay, plus the mentors will be giving you separate PDFs other than these ebooks in the classes. Okay, so that's huge. And double validity, you buy for 6 months, you get it for 12 months. Buy for 12, get it for 24. Free. But for that, always remember, don't forget this code. Code is very important. And use the app. Download the app first. Y432. Okay. So bye from my side. Okay.